All right, we will get started. I want to get my pen going here. Ink color. Okay, that's good. All right, so I will go ahead and start the webinar. I'm going to also put you guys on mute. Hopefully, there, I got you. Okay, we'll go ahead and start the broadcast, and then I'll give everybody a couple extra minutes here.
The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. It's Dave. We'll be getting started in the next few minutes here. I'd like to give other attendees a couple of extra minutes to sign in case there's any technical difficulties that they might be having. But we'll go ahead and get started in about 2 minutes. Thank you very much for being here tonight. Thank you very much for your patience. We'll go ahead and get started. If you guys don't mind, I want a quick double check to make sure everything is working correctly technically. Could someone please give me a yes in the question box just to make sure everybody can hear me? Thank you very much for that, Mike. Okay, so we'll go ahead and get started. Good evening, everybody. I want to welcome you to our Tuesday night webinar series. My name is Dave Aquino, and I am the Options Live Trading Room Specialist here at Microquant. One of my colleagues, Doug DeRosa, he is the Stock Live Trading Room Specialist. He's also here with us tonight, and he'll be helping answer any questions as things go on. Thomas Wood is also here with us. And so, Thomas, if anybody has any questions for Thomas, we could also direct that to him. But I just wanted to say hello to everybody. I see that there are a number of people from my Options Live Trading Room. I guess you guys can't get enough of me during the day, so you have to get some more of me at night. So I know we're excited about this session tonight, because it's basically the fundamental aspect of how we run our Options Live Trading Room. So I'm happy to share that with everybody tonight. Again, let's go ahead and get started here. Okay, so again, tonight I'm going to be talking about how to trade weekly options. Now, I'm going to touch on and review some fundamental aspects of options first. Then I'll go into a brief primer on how to pick appropriate options to trade based on the day of the week and the type of strategy you're trying to implement. That's kind of unique. You normally don't say, what does the calendar have to do with what I trade? But I'll show you tonight, and you can see that after this session, you'll see how it's important. And then after I go through some of the basics, I'll go ahead and show you how to apply what you learned to actual stock charts and actual trades. Okay. If you think of any questions at all during my presentation, go ahead and submit them to the questions sidebar via the GoToWebinar side menu. Now, please note that we're going to be talking about a limited aspect of options, kind of limited on the type of strategies we're doing, because if we really went in depth, this could take a couple of days, you know, and I would just be just getting into options. There's a lot of different factors that make it kind of complicated, but I'll try to simplify it for the purposes of what we're going to talk about and show you a glimpse of how we use them in the Options Live Trading Room. I'll try to answer the questions as they come in, if they're related to the current slide or current topic. Any remaining questions that you might have, we'll try to answer them all in the question and answer segment at the end of the presentation. And before we leave tonight, I'll make sure that all questions will be addressed. Okay. This is our risk disclaimer. We at MicroQuant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from the inability to access such information or in any delay in or failure of the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration only and example only, and are hypothetical and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. That's pretty much the bottom line. CFTC Rule 4.41. This is a U.S. government required disclaimer. The CFTC wants you to know that the futures and options trading not only has large potential rewards, but also large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Do not trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy or sell futures, stocks, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions on either of these two disclaimers, feel free to go ahead and contact us at MicroQuant. Okay, now moving on to the topic of tonight's webinar, how to trade weekly options. That's the topic. Again, what I'm going to be talking about are first the characteristics of or traits of options that control the price of these options. The types of options that we trade, there are only two, puts and calls. Everything else can be done with combining puts and calls. Third is we're going to discuss the traits of weekly expiring options and the types of trades and strategies you can do with them. And then last, we're going to talk about the types of trading you can do in weeklies or weekly expiring options and what's the best days of the week to do each of the type of strategies. Okay. Now I'm going to be throwing a lot of stuff at you, and you just try to sit and try to understand what I'm trying to relay, and then I'll show you some trades. Again, it's a lot of information. Feel free to send me questions. Okay, the next thing, again, we're going to be saying is, what are options? Basically, they can be thought of as trading vehicles that derive their value from the characteristics of an underlying stock. Okay, they actually don't have value that that's derived from anything inherent in themselves. Everything is linked to the underlying stock. Characteristics are price, implied volatility, and time until expiration. Those are some major factors in the different pricing models of options. Okay, the next aspect is options also have certain traits that are desired by investors, mainly leverage and defined risk. You'll see this later on when we start talking about directional options and then puts and the spreads of how we combine puts and calls. Okay, so these characteristics and aspects of trading options are another layer of complexity that we talk about in our options live trading room. But for the purposes of this webinar, we want to go ahead and discuss again the basic understanding that these are trading vehicles that derive the characteristics from underlying stock. A little bit more background. Options are traded on the Chicago Board of Options Exchange, the CBOE. The CBOE is, again, their home exchange, but the CBOE is also involved in standardization of option contracts, the size, the strike prices, the contract specifications, when they're created and when they expire. The types of options that we have are on stocks. Normally, they are monthly issues. When I say regular stocks, you're not talking about the high volume stocks like Apple or Google. We're talking about stalwarts like Boeing, Shearing Plow. They are the S&P 500 large caps that don't necessarily have the trading volume some of the more highly traded stocks have. You can't compare and contrast Apple to Boeing. You'll kind of have a feel for what I'm talking about. They tend to be less volatile stocks. Now, these monthly issues expire on the third Friday of every month, which happens to be this Friday. And it tends to be it tends to be make the markets a little bit jumpy when you're getting to the third Friday of every month. Now, specifically, the weeklies are on highly liquid stocks. And when I say weeklies, I'm sorry. Weeklies are the weekly expiring issues. Every Friday, they have a set of options that expire. Now, these are on highly liquid stocks. Specifically, good examples are Apple, Google, Amazon, things like that. And then also in index futures and ETFs. Those are also those types of trading vehicles also have weekly expiring stocks. And basically, weeklies were created to provide additional opportunities to buy and sell short duration options. Roughly, I was looking at the CBOE website because they maintain a list of the current weeklies, and there's over 200 plus different stocks or ETFs or indexes that have weekly issued options. So there's a lot of opportunity to pick and choose, different, stocks and trading, underlying trading issues. Okay, now the general characteristics of options. This is kind of where everybody starts kind of rolling their eyes a little bit and saying, I kind of lost me there, Dave. But we call them the Greeks. Okay, again, the options don't necessarily have an inherent value to themselves. It's the traits of the underlying that dictate what the price of the option is. And we'll just go walk through the list here. We have delta, theta, vega, gamma, and rho. You could make your own fraternity and sorority with all those, okay? And but basically, they're actual factors in what they call the Black-Scholes option pricing model. The individuals that came up with the Black-Scholes pricing model for options actually won a Nobel Prize. So, but specifically, we're going to be talking about delta, theta, and not especially tonight, vega. I put vega here because this is actually very important. But the two that we're going to talk tonight are delta and theta. Okay, delta is basically how the change in the price of the underlying affects the price of the option. Okay, that is important. How the price of the underlying changes and how it affects the price of the option. And then the second is theta. That describes how the time left until expiration affects the price of the option. Okay, those are the two that I want you to focus on. Vega, it's how price volatility of the underlying affects the price of an option. And then gamma is the rate of change of delta. Okay, you're like, Dave, kind of lost me. Gamma is a little bit more complicated. But then rho, we don't really talk about rho very much, is how interest rates affect the option price. The current market environment of interest rates, it's so low, rho doesn't really factor into the current pricing of options. Okay, now let's just go into a little bit more detail. It's kind of easier to explain. Again, here we're talking about delta, and remember, delta is price. Okay, sorry about my scribble. Okay, now specifically, delta is assigned to the option based on, you compare the strike price of the option to where the current price of the underlying is. Now, yeah, it is a little complicated to understand, but basically, if the price of Apple is at 400, okay, and the current strike price of the option is at 400, okay, then our delta is going to be 50, okay? If the current price is at 400, but the strike price of the option is, say, 350, it's in the money, our delta is going to be 70. Like what, Dave? And then if the strike price that we're looking at is at, say, 430, and the price of the option is, and the price of the underlying is at 400, this is out of the money, okay? This is for a call, and it's a little hard to understand, but the important fact to derive from this chart is that the more the option is in the money, the more likely it trades like the stock, okay? That each dollar that the stock increases in value, the value of the option also increases in value. So the reason why I put this slide together, and if you guys are here enjoying this webinar, you have a little interest in options. Sometimes you get people that say, hey, buy the Delta 20, it's really, really cheap. It takes, the reason why I put this together is you can see that it takes a whole lot of price movement in order for this to actually gain in value, okay? It takes forever before it actually increases in value. Whereas here, if we're buying the Delta 70, and this is usually what we trade in the options live trading room, for every dollar that this goes up, the option increases by 0.70, okay? So that is that increases much rapidly, and as the price goes in the direction we want it to go, the delta actually increases. So we actually increase the rate at which the option increases in value. All right. So, but again, the most important factor is concentrate on the Delta 70 options. No questions yet. Again, feel free to ask me any questions you might have. The other aspect of option pricing is theta that we're going to concentrate on today. Theta is the decay in price. And basically, theta is that the closer an option is to expiration, the quicker it loses value, okay, if the option is out of the money. I'll explain that when we talk about spreads, but basically, if this is out of the money, meaning there's no intrinsic value because the strike is far away from the strike is far away from the current price of the underlying, but basically it's out of the money. And the important factor is that as we get closer to expiration, and say this is a weekly, there's 7 days, the value of the option decreases rapidly in this last day, okay? We're 7 days away. From 7 days to 3 days, the price only goes down by, say, this much, okay? From 3 days to 1 day, from here to here, okay? And then from this last day until the end of the trading day, it goes down this much. You can see how the decay in price accelerates as we get closer to expiration, which is 4 o'clock on Friday. On weeklies, it's every Friday, okay? The way we take advantage of this is that we sell this. We sell this to somebody. So if we sell it for a spread or an option for 40 cents here, and then price stays the same, by midday here on Friday, this could be trading at 10 cents. We sold it for 40. We could buy it back for 10. If you sell something for 40 and then buy it back for 10, you know, you just earn 30 cents. Okay, that's how we take advantage of theta decay. We sell something that is rapidly declining in price. We can let it go to expiration, we can let it go to 0, or we can cut our risk and go ahead and buy it back. So it's a complicated thing to think of. Hopefully I tried to explain and illustrate a little bit how decay accelerates. You can see it from the chart. And then to conceptualize, put it in more concrete terms. If we sell something for 40, here on the third day, here on the 1 day till expiration, it might be just worth 20 cents. Close the business on Thursday. Midday on Friday, it's only worth 10 cents. And then later on, it could be worth 0 cents if it doesn't intersect the short strike. Okay, I'll show you that, but I just want you to understand and visualize how theta decay works on the price of the option. Okay, any questions so far? Okay, I think that's a little bit the most complicated theoretical kind of idea I'm trying to convey tonight. So if you got that, we're okay right now. All right, so the types of options that we can buy and sell, there's only two. One's a call option, and basically it's the right to buy stock at a fixed price, we call that the strike price, before or at expiration. Now, this is just the textbook definition, the right to buy a stock at a fixed price. So basically, Apple is at 400. You buy an option with a strike price at 400. The price of Apple goes to 450 by the end of the week. Okay, because you have the option, you can buy the stock at 400 and you can sell it to someone at current prices at 450. So you earned $50. Okay, that's how you can conceptualize a call option. Now, when we are bullish a stock and we believe the price will rise, we can buy a directional call like I showed you here, or we can sell a put spread. You'll be like, you can say, Dave, what did you do there? Just tuck this in the back of your mind, because these are two bullish strategies: buy a directional call or sell a puts credit spread. Okay, important thing is it's a credit spread. Okay, and I will show you how we implement that. So basically that is what a call option is and how we can trade it. The next is a put option. Put option is the right to sell a stock at a fixed price before or at the expiration date. Again, we're going to use Amazon. Amazon is trading at 450. Okay, let's do a different number. It's 800. 800. Hold on. 800. Okay, you believe the value of Amazon is going to go down, so you buy a put for 800. The bottom falls out of the market, and now it's trading at 700. Okay, put gives you a right to sell a stock at a fixed price, 800. Okay, now you sell it at 800 and you buy it on the market for 700. So you're plus 100 profit on this. It's basically you're selling it short. Okay, so again, if we're bearish a stock and believe that the price will fall, we can buy a directional put, or we can sell a call credit spread. Okay, it's basically the opposite of what we did here. Similar but different. Sell a call credit spread. Right. Okay. I'm just double checking, see if anybody has any questions. Ron, you are correct. When I was showing this theta decay, it's out of the money, right there. OTM. It's a little bit more complicated, but it's still. I'm just trying to relay the idea of what theta decay does. Okay, and then I will show you some charts later on, Nag, about how we trade these options, and it will have value charts. Okay? Any questions on call and put options? Okay, I try to kind of keep it simple, but options in and of themselves are not necessarily simple. So we'll just go ahead and continue, and you guys just hold on. All right, again, from the aspect of are we bullish or are we bearish, everything comes back to that. You can have a dozen strategies, but they always boil down to the first thing is, are we bullish on a stock or bearish on a stock? If we are bullish on a stock, we can do one of two things, and I mentioned this earlier, but we can buy a directional call. The stock price goes up, the call price goes up. Very straightforward. This is how we're profiting here because of delta. Okay, stock price goes up, call price goes up. Very straightforward. The second thing we can do is sell a put credit spread. Now, I will show you this later on, but just listen and take in what I'm saying about a put credit spread. When I sell a credit spread below the current price, I collect, an important thing is I collect a premium at expiration. Okay, I collect a premium at the time I sell it. At expiration, if the price is above the short strike, the short put strike, okay, above, because what we're doing is we're being bullish. We think prices are going up. So if the price is above a certain strike price, we get to keep that premium. Usually in the trading room, we look for anywhere from 20 cents to 40 cents per contract for a $5 wide credit spread. If you guys are familiar with that, that's normally what we do, 20 cents to 40 cents. So that's anywhere from $20 to $40 per contract. Okay? So usually I trade around 10 contracts every week in a particular stock. I'll show you that later. So that's kind of the idea of what we're collecting, $20 to $40. If price is above the short strike, then we keep 100% premium. Like if I sell it and Apple is trading at 400, and that's the short, and then I sell that's where the stock is right now, 400. And I believe that we're going to go up from there. I can sell it at the short strike at 380. Okay, you're like, Dave, what are you talking about? 380. Basically what I'm saying is I don't believe the price of Apple will go below 380 in the next 3 days. That is what my trade is. So that means I'm bullish Apple. I think it's going to go up. It can stay where it is. Honestly, it can stay at 400, or it can go to 410, 411, 412, 499. It doesn't matter. I get to keep this $20 to $40 a contract as long as the price of Apple stays above above 380. Okay, that is the idea of a put credit spread. All right, hang on, because basically we're going to say the same thing, but to the downside. Bearish. If I'm bearish, I feel the stock price is going to go down, I can buy a directional put. Very straightforward. Stock price goes down, option price goes up. Okay, does that make sense? I'm making, because I'm bearish, I will make money if I'm saying that the stock price should go down, and it does go down, the value of my put option will go up. Okay, and then what I can do here, just like we did when we were bullish, we can sell the opposite, a call credit spread. Basically, again, we sell a credit spread above the current price and collect a premium. At expiration, if the price is below the short call spread strike price, we get to keep 100% of the premium. The parameters are basically the same, $20 or 20 cents to 40 cents per contract, which is again $20 to $40 a contract. Okay, now in this example, let's say it's Amazon. Amazon is currently trading at 500. Okay, I believe it's going to fall. So I write the call credit spread for say 525. That's what I call the short strike. I want prices to stay below this line, below 525. So as long as it stays below 525, I get to keep the $20 to $40 per contract. Okay, and if it goes to 500, it goes to 499, and it parks there for 3 days. These go to expiration, and I keep 100% of this. Okay, does anybody have any kind of questions? I mean, the directional puts and calls are very easy. If they go in the direction we think they're going to go, we make money. The credit spreads, basically, it's a game of keep away. We want to keep away from the short strike based on which direction we think the market's going to go. What's nice about credit spreads, you don't have to be right. Okay? The only way you're wrong is if prices go up. If prices go sideways or down, we win. What delta do we sell the short strike at? I normally don't look at deltas when I sell the short strikes. I'll show you on the charts. We sell the credit spreads based on the outlook we have on the underlying stock, based on support and resistance levels and distances from the current price. But we normally don't look at delta there. We basically don't. But well, I'll show it to you. Okay? All right, the next aspect we want to talk about is trading on a weekly calendar. Now that we know the types of trades we're looking for if we're bullish or bearish, we want to ask the next question is, when do we do each? When do we do directional? When do we do spreads? And it's based on what day of the week it is. And again, this is if we're trading weekly options. Okay? Basically on Monday, we are buying and selling directional puts and calls. If we are swing trading, this is anywhere from 1 to 3 days, an outlook on 1 to 3 days, we are buying puts and calls. And then there are some times where we can start selling early spreads. You know, normally we don't get into this early because they don't expire until Friday. Okay? They don't expire until Friday, right here. So we have Tuesday, Wednesday, Thursday, and Friday to get through. We kind of don't want to do that. It gives the underlying too much time to move up and down. So we really don't get into spreads this early. This is because we want theta decay to work in our favor. Remember the chart back here? Sorry, I know I'm jumping. Remember theta decay? 7 days, 5 days, Monday, right here. This is Wednesday. Oh, that's terrible handwriting. Wednesday, 3 days. This is Thursday afternoon, 1 day, because you still count the entire day of Friday as 1 day. Okay, so where on this curve, if something you're going to sell something that expires, you want it to rapidly decline in value quickly. Okay, so you want to sell it closer to here where the slope is greater. Okay, so jumping back. All right, the next day, Tuesday, today, we can do directionals, especially intraday. Swing trading, we have a swing trade in place from Monday. We do have one of those in the options live trading room. And then we've already started doing our spreads. Sometimes what we'll do is we'll nibble a little early. If we want to do 10 contracts in MasterCard, if it looks good, we'll go in with 3 on Tuesday. Okay? Certain factors we ease into spreads also. We can talk about that, but again, early spreads. Wednesday is kind of the really good day to do this because we can basically do anything. Okay, we can go directional because we still have Wednesday, Thursday, Friday that we can have till expiration, and then credit spreads start to look good because you have to balance. As we get closer to Friday, it's harder to get that 20 to 40 cents per contract. Here on Monday, I might get 40 cents for a spread with the same risk. Tuesday, I might get 35 cents. Okay, I can't write. Sorry, 33 cents. Okay, and then Wednesday, here I'm getting 25 cents. Now, if I try to do it on Thursday, I might get 17 cents. Now, you're saying, well, Dave, does that matter? Yes, it does, because on a $5 wide spread, our risk is still the same. We're just getting paid less to take it. So you have to balance how much you earn with how much you risk. So that's why credit spreads gives us a good balance. We still get a decent amount, and we limit the amount of time we have until expiration. We don't have 5 days, we just have 3 days. Okay, Thursday, what we do is if we have a longer term directional type trade, we may start doing those with the next week out. Then we may leg into some late spreads or add some last minute contracts to current spreads. And then what we could possibly do, and this is something that affects delta, because as we get closer to the end of Friday, the deltas shrink. They become very narrow. And we'll only use the current week for really quick scalps. Okay? It's kind of hard to explain without showing you. I show you a lot in the options live trading room, but just take my word for it. Current week options that expire tomorrow on Friday, we usually just use them for quick scalps that are in and out, and I'll show you that also. Friday we tend to have a more quiet type day. We manage and close spreads. We manage spreads that may be going against us. We manage spreads that are really far away, in that we just want those to expire. And then anything that's kind of intermediary that may or may not go against us or may not expire worthless, we'll close those spreads out. We'll cut our risk. We'll buy them back. We'll buy the short legs back. I know I'm throwing a lot of information at you, but I just want to get it out there so you kind of start thinking about it when I show you examples. Okay? And then we start looking at next week directional trades. And then again, current week scalps, really, really tight scalps, are probably in the morning on Friday. We have like a divergence trade that might last just 15 minutes. Right. Someone's asking me, wouldn't it make sense to sell the next week's, okay, like okay, it's Friday, okay? I have the weekend coming up. I have Saturday, Sunday, and I want to go ahead and sell the credit spreads that are going to expire the next a week from this Friday. Can we do that? Well, everybody knows that there's a weekend. So the option price, the market makers take that into effect, and they start pricing down next week's options late on the day on Friday. So in essence, you're not getting necessarily as great or much theta decay from Friday the week before to Monday. So you're not basically, if you bought and sold at the exact price Friday and Monday, you're really not going to get much in theta decay. That's another reason why we usually draw this line here and saying we don't necessarily want to start selling premium Monday and Tuesday, because that time decay is really slow compared to Wednesday, Thursday, and Friday. Okay, and everybody knows the weekends here on a weekly, because those weeklies are already here. They're available to sell on Friday, but everybody knows the weekend's there. So they're going to factor that in. What exactly, another question is, exactly on what day the weeklies are open for trading? They're open every day, Mike. Maybe your question is, when are they created? I looked at the options chain for Apple today. Weeklies are available for the next 4 weeks. Yeah, they usually go out about a month. But I'll tell you, the volume in the weeklies don't really pick up until the week they expire. There are 3, let's say there's 4 weeks in a month, roughly. 3 of those are weeklies, 1 is a monthly. And there's definitely more trading volume in a monthly, because the monthlies expire this Friday. But weeklies are usually available for about 4 weeks. Okay, does that answer everybody's question? Okay, this is kind of the essence of how you trade weeklies right here. This chart here kind of I try to show you how you do it. Monday, Tuesday, Wednesday, buy options. Wednesday, Thursday, Friday, sell credit. It's that straightforward. The one thing someone asked, do I buy options on Friday? Yeah, I can do a swing trade, that may span from one week to the other. The only thing is, other than like futures, which, I mean, they don't trade on the weekends, but they can trade pretty much 24 hours. Options only trade during market hours. So like when you have economic reports that come out at 8:30, you are a little bit exposed when you can't get in and out of these options. You can have stop losses and everything, but it doesn't take into effect until the market actually opens. So it can actually jump your stop loss. So you got to be careful. You can go into swing trades, and I'll go into that. Again, early in the week is when theta decay is slow. That's why we can buy options even for swing trades that we could hold for 1 or 2 days. By Wednesday we can start being a little more cautious buying directional options for longer trades. I'm talking about 1 to 3 days. But then we start selling premium or start selling credit spreads. By Thursday and Friday, we're just again finalizing our credit position, our credit spread positions, and then starting to close out the successful positions or managing them so they expire on Friday. I always tell my options live trading room that when I start having spreads, I don't leave my desk. I watch my spreads the whole time. Basically, I'm babysitting them, making sure they're behaving. And if they start going against me, what defensive actions can I take? Okay, here you go, Mike. I got you. Okay, let me remove my chicken scratch. Okay. Sure. Does anybody have any additional questions? I'm about to go into some chart examples now. So if there's, it may be a little easier to see if I show you on charts. And another thing too, at the end, I'm going to invite you to my options live trading room so you can see this stuff in action. Okay. Mike, what I'll do, I'll go ahead and move forward, but I'll put this back up at the end of the webinar. So please remind me in case you would like it to come back up. Okay. All right. Okay. Chart examples. Now, these aren't the only examples I can do. I can pull up TradeStation and show you some more. But okay, this is an example of a directional put we did in Apple. This is an intraday trade where we're trading in and out very quickly, same day. These can be any day of the week. We use the current week weeklies, but we're a little careful on Friday because Delta gets really narrow and it gets kind of volatile. It's a little hard to explain. Right. Let's see. Greg, I'll get to your question in just a second. So directional puts in Apple, and this is on a 250 tick bar chart. In the options live trading room, we normally watch a couple of these major weekly stocks, specifically Apple, Amazon, Google, and Tesla. Tesla is one we've added recently. But right here, you can see this is how we trade this. It's a directional, so we buy a directional put. In this particular case, we have a bearish divergence. Okay, we have higher highs. We go short here, and prices fall. We purchase a put, a Delta 70 put. Again, the current week weeklies, and the prices fall, and the value of our put increases, and then we get out here at the blue, at the moderately undervalued level. But this type of trade can be done any day of the week. You can see, well, it doesn't show you here the time scale, but we're actually in and out of this in 10 minutes. Okay, this occurs about 35 minutes into the trading day. And we do a lot of these smaller term scalp trades. This particular trade, this stock, we moved from about 433.25 down to 432. So this is about $1.25. Okay, Now, I don't have the exact numbers, but I can tell you we do enough of these that we know. So it's a $1.25 move in the underlying. It's a delta 70, so we multiply it by 0.70. We make about 88 cents on an option. Now, these options usually go for $10, roughly, $10 a contract, and we make 88 cents on $10. That's 8.8% return on that move right there. So that is, if we $10 an option a contract, that's $1,000. So we make $88 a contract. Okay, if you buy 10 contracts, you know, that's $880. Just depends on how much you want to commit. But that's the kind of leverage. This is why I put this in here. This is the kind of leverage that we experience by utilizing options. Risk reward ratio. Usually on a trade like this, I'll risk about $100 for the particular option. Again, this is a scalp trade, and it depends on the type of trade. Sometimes if it's trend following, then I will usually we'll risk 100 and we can make 200 to 300 on the trade, sometimes 4 if it's a trend following trade. Sometimes the divergences like this, it's 1 to 2. In this particular case, we risked, it depends on the trade actually and how it works out. We don't necessarily sit here and calculate, okay, this is I know how much risk I'm going to take, and usually it's about $100 a contract, but it just depends on how the trade unfolds as to how much we can make. I did the same trade today in, again, you said this is about $88 or $90 a contract we made here. I did the same, very similar trade in Google, same 250 tick bar chart. The price movement was about $2.75. And I traded 10 contracts, and I made, was it 10 contracts? No, it wasn't. It was 5 contracts. I made $680. Okay, but again, I'm kind of wanting to pull away from that. That's not the focus of kind of what I'm trying to demonstrate. What I'm trying to show is just how we utilize directional puts. Again, this could be Monday through Friday. Okay. All right, the next trade is a directional again in MasterCard. Now, this could be an example of this is a daily chart. I don't have the specific date, but let's just say this is Monday. Okay, Monday, we see the chart, this particular chart pattern. We see MasterCard opens here on support and then moves up. We notice here that NQ momentum is decreasing to the downside. And we actually see on this particular bar, we get a green histogram bar, and the indicator line slope is positive. So we go ahead and purchase a delta 70 call that is expiring by the end of the week. Now, in this particular case, we had a strong move Monday. Tuesday it pulls back a little bit. Wednesday it goes up. We're looking at this and we want to go ahead and extend it. There's nothing to say that we can't take our profits here on Wednesday and then go back and buy the same call a week further out, and still go ahead and benefit from current movement of the price as it continues up. Because basically, when we're looking at the chart, everything's telling us this will probably continue, at least to maybe test this resistance level at 589.05. Okay, so this is an example of a swing trade. What we will normally do, because we're getting in on a daily chart, we're taking the trade off the signal on the daily, we will look at a shorter term chart, maybe a 60-minute chart or a 15-minute chart, and look for an area of opportunity to get in, maybe a divergence. But the most important factor is the fact that, again, if we're getting in this on a Monday, we can go ahead and take this trade on the current week's weekly. Again, Tuesday is another day we can do that. Wednesday, Thursday, Friday is when it gets a little bit, you start questioning, okay, do I want to really get into a directional trade? Again, if I think it can persist throughout the weekend and into next week, then I can go back out and with those other weeklies, go out maybe 11, 15 days. Okay, that actually enhances my leverage by utilizing the shorter term weeklies. Any questions on that? That's an example of a trade that I may take on Monday and a Tuesday, possibly even a Wednesday. Okay, and then the next trade is, this is a Google daily chart. Now, say it's now, say that back here, or today, this is a Wednesday. Okay, then I start thinking to myself, do I really want to get into a directional trade here? What can I possibly do? I see we're now above support in Google. I don't know what it's going to do Thursday, Friday, but I don't necessarily, especially if I see it's moving a little bit, I don't know if Google will continue up to test this resistance level here. That's what I'm assuming because of the way momentum's going. But, you know, what can I do to still take advantage of the trade? And sometimes we use this if we feel that, oh, I wish I could have gotten in here. I wish, you know, maybe it's started to move without me. What can I do? What we can do is sell, and again, we're bullish, so we can sell a put credit spread. Okay? Basically, we will sell the 860, okay? And we will buy the 855 calls, okay? Just kind of trust me on this. This is a $5 wide difference in the strikes, so that our exposure is like $5. But what we're going to do is we're going to collect a credit, and this is just pulling it out of a hat, but it's a good example because we'll pull out 35 cents a contract for these spreads, or $35 a contract. Now, basically what we're saying is that the short strike is 860. See this level right here? We're saying that the price of Google will not fall below 860 in the next 2 days, Thursday and Friday. Okay? If that is the case, then we keep the $35 a contract. If we write 10 contracts, this is $350. Okay? Keep the 350, and the fact is, you know, if it, let's just say it does continue up, gets to expiration, we're still above 860, we keep all $35. What happens if it starts to move against us? Okay, that by Friday we're sitting right here at 864. Okay, 864. Okay, it could punch down through 860 before the close, and we could kind of be on the we could be a little bit on the loss side of this spread. What we can actually do is, if we probably look that up by Friday morning, what we sold for 35 cents, we could buy back for 20 cents. Okay, sometimes we do this, 20 cents. Okay, the trick is, what do we do here? We sold it for 35, we can buy it back for 20. That's a plus $15 a contract. Okay, would you do that trade? It depends on what you think that the price may do if it goes against you. If it gets close to that short strike, usually what I do, and there's a bit of a profit, I take it. I take it. I don't have a loss. I have a small profit. I don't let greed control me, because I intend to do this type of trading every single week of the year. So as long as I can take a profit, I'm okay, because I cut my risk. Sometimes we just buy the short strike back. We can do that too if we're really close to expiration. We don't have to buy back the entire spread. And Mike, you're saying, why not sell this put spread on Monday to get 45 cents? Okay. How many days, you see what Google did? Sorry, I have to kind of get rid of this. There's too much writing. See what Google did in the past 4 days? 1, 2, 3, 4. Okay, it moved. I can't tell you what that is. $40, $35. What happens if our exposure were just this period here? It moved 15. Okay, $45 versus 15. If I have a bullish outlook I have a higher probability of knowing what this price may do over the next 1 to 2 days rather than looking out 4 to 5 days. Okay, Bernanke might say something wacky tomorrow, and this thing just drops along with the rest of the market. So I always have to say what is the potential of loss risk that I'm taking. Again, I take a trader's mentality. We're always trying to cut risk. Okay, what risk control tactic do I have for credit spreads? Do I try to adjust the price? If it goes against me, my usually cutoff, if I'm earning $100, I'll usually let it go against me to 200. Okay, because again, time decay is working in my favor, and this could be just a temporary move and it just bounces back. But usually I'll cut it off at a $200 loss. If I can earn 100 and it goes against me, I'll go out at 200. Now I do this because I don't just take one trade. Normally we do anywhere from 5 to 6 spreads every week in the live trading room. So it's almost like a bonus at the end of the week. That these are trades that have just been working, and we're actively doing intraday trades, and then by the end of the week, oh yeah, here's some extra credit, here's some extra premium, and we allow them to mature. I have no problem. And again, one other thing too, not only do I don't hesitate to take this loss if it really starts to move against me, but what I also will do is if it looks like if I'm bullish Google and then the next day it starts to move against me here, and I can get out at break even, I'll get out at break even. I don't have to hold it to try to get the profits. Break even is just as good for me, that I don't lose anything. So again, let's go ahead and continue. Just a couple of more things. I think this is the last slide, and I just wanted to demonstrate how we look at credit spreads a little differently. We think this is going to go up. So what we try to do, we try to think defensively. We don't think offensively like, ooh, I'm going to get in here and prices are going to go up. No, what I think of is where are they not likely to go? Where are they not likely to go? That's why support and resistance levels are very important. Here's the low of this inflection point. So this is a good level here. If I could I write a spread down here at 840? Yes. Why? I have this resistance level, this is now support, this trend line here, which is now support, and this resistance level here, which is now support. So in order for this price to hit my short strike way down here at 840, right down here, I have to go through these guys. Okay, it's kind of like I think of football linemen. I got this lineman, this lineman, this lineman. All these, the price has to get through all those guys before they threaten my short strike. So it's a opposite way of thinking, and I kind of like it. I think it's kind of cool because it can really utilize the support and resistance levels very well that give us protection. So not only do we have the idea of what is momentum doing to help carry the price away from us, but we also have support and resistance levels to give us additional levels of protection. Again, you kind of have to visit the options live trading room to get an idea of that. Okay, how many trades do I do in a week? And it depends. Usually I can do 2 to 3 intraday trades every day. I might do 1 to 2, maybe 3 swing trades a week, and then 5 to 6 and maybe a little bit, maybe a couple of extra more swing trades depending on reversal candlesticks. And then on the weekend, I mean, towards the end of the week, I might do 5 to 6 spread trades. Bankasamy, we can talk about that in the options live trading room. He's basically saying if we woke up tomorrow and a spread was moving against us because of something an analyst said, there's certain ways to handle it. We just have to see how the price action opens up in the morning. Is it a knee-jerk reaction, or is it something more significant that may carry the price down? And we just kind of have to manage it that way. Again, always understand that when you do a spread, you're at a risk of it going against you, just like any other trade. But we can talk about that too. Thank you for your question. Okay. Again, let's just summarize here because I've taken up your whole entire hour here. Let me go ahead and summarize the essence of this webinar of trading weekly options. Important takeaway points. Options provide a great deal of trading flexibility and leverage. Not only can we be offensive and buy directional puts and calls based on which way we think the market may go, but we can also sell credit, sell premium, so that we can benefit from the fact that time is passing and we're still trading within the general framework of how our outlook is the stock can move up or go down. So a lot of flexibility in our trading. We also, it's important for you guys, if you're going to trade options, to learn how to profit from time decay by writing credit spreads. It's a great way to trade. You can earn some consistent, high probability income. Just have to do it the right way. Use support and resistance levels, use momentum to help you determine which direction is the stock going, and what kind of protections do you have, and where to write the credit spreads. And then best practices, use the weekly calendar to determine the best option strategy to use. Again, I'm going to go ahead and jump back to that chart that I originally had up, and I'll just leave that up while I answer the questions. But this is a very good framework to determine what types of trades to do. Okay, let me just see. Oop, I'm sorry. Just didn't realize my mouse would mess that up. Okay, basically we've come to the question and answers part of the evening. I think I've already answered almost all the questions as they come up. If anybody has any additional questions, I don't want to keep you longer than the amount of time you've so graciously decided to invest with us. Hopefully I've given you a lot of good information. I know it's just scratching the surface. Okay, I'm going to get off this particular chart and jump to the end here because I don't see any additional questions, but I want to do this here. I'm sorry. Okay, I think the best way for you guys to get a better feel for these type of trades, I'd like to go ahead and invite you to my options live trading room. Again, this is where we focus specifically on trading setups with options on stocks. The big stocks that we trade: Apple, Google, Amazon, Goldman Sachs, MasterCard, LinkedIn, Netflix. Those are good, all the type of stocks that we trade on. And we focus on intraday trading, swing trading, specifically puts and calls, and then credit spreads. The trading room hours that we have are 9 a.m. in the morning to 1 p.m. in the afternoon. The normal price is $149 a month. Now, this is my particular email address, dave@microquant.com. But the one thing I wanted to show you really quickly, again, if you like what you hear, if it sounds exciting and profitable to you, why don't you come visit us tomorrow? We actually have a free day of live trading in the options live trading room. Again, 9 a.m. to 1 o'clock. Now, the one thing is I don't have a clickable link for you, but I know that an email went out today around 2 o'clock today to all valuecharts.com email subscribers. And there's a link that you need to register on, and then you can get into the live trading room for free tomorrow. I'd love to host you. If for some reason you can't find this link or have some difficulty, send me an email. Again, it's dave@microquant.com, and we can work it out for you, get you registered. If for some reason you can't make it tomorrow and you have an interest in the trading room, send me an email also. We'll work something out so you can come and visit on another day that's convenient for you. Again, these are some complicated strategies, but I try to break it down to make it simple. In the live trading room, I talk through all the trades and the strategies involved. I let you know what I'm looking for. I show you how to manage certain positions. Again, we have a swing trade involved. Let me just see if I have the current. I don't have the current screenshot that I can show you, but we had a very good day. We our profits today were well over $2,000. We had very good intraday trading because there was a lot of divergences we took advantage of in Apple, in Apple, in Tesla, and in Google today. Google was the one where we traded. We made about $680 on that one trade. But again, in addition to the intraday trades, we have a swing trade on in Netflix, and then we also have 4 credit spreads going on now that we're actively managing. And again, tomorrow's actually a good example because we need to manage around the fact that the FOMC minutes are being released around 2 o'clock, and then Bernanke's actually talking. So we kind of have to watch how the market's responding, how it's kind of quiet, whether or not we add additional positions to the spreads, things like that, and how we trade intraday. We got to be a little careful and a little bit aware of that. So this is a good day to kind of get in. And again, tomorrow's Wednesday. So Wednesday's a day we can do a lot of these different strategies. It's a better day to come and visit than, say, Friday. Again, if you guys have any additional questions, let me know. I'd really like to host you. Does anybody have any additional questions about the subject we talked about tonight? Again, here's my email, dave@microquant.com. Be happy to answer them. Let me know. Okay? Again, thank you again for spending the time with us tonight in this webinar session. I hope you found it both informative, not too much over the top kind of stuff, and I hope you found it exciting because I'm really excited about being able to trade options on stocks. It provides a lot of different flexibilities in my trading. So that's why I trade it. If you have any questions or comments, you can direct that at support@microquant.com or send it to me directly, dave@microquant.com. Again, my name is Dave Aquino. Hold on one second. I think one more question came up. Do I use standard deviation envelopes to determine? I'm sorry, Greg, I don't use standard deviations. I'm aware of them. I know how to trade with them, iron condors, and the different kind of strategies. The one thing is I don't find that I can use my advantages of value charts and momentum with those types of trades because I tend to be able to use value charts and momentum to determine which way the prices are moving. So I tend to try to favor those as opposed to just a mathematical calculation. Okay, this is 2 standard deviations out. This is where we should write it. Because in all honesty, the stock price does not care how many standard deviations it moves out. And I understand the probability of it, but I've done iron condors in the past where it goes right through the second standard deviation, and yeah, it's 98% likely to stay within that range, but the 2% that it doesn't really kills you. Okay, why do I trade stocks versus indexes? I like stocks a little bit more, and now we do spiders, the Qs, the DIA for the Dows, the diamonds. I'm sorry, I couldn't remember what they're called. We do those once in a while, but I like the movement of the individual stocks a little bit better. There are strategies with the ETFs, and it benefits from the diversity of it. It's not as volatile, but volatility is one aspect that actually increases the returns in options. You want it to be a little volatile. You don't want it to be too plain vanilla, because you're not going to write spreads with any premium, and it's kind of harder to make money that way. I want something that I can trade. Okay, you're very welcome, Greg. I hope you guys consider visiting my Options Live Trading Room. I think you can get a lot from visiting. So please let me know if there's anything I can do, answer for you, suggestions, questions on trades or strategies. Send them to me. Be happy to start a conversation with you. Again, my name is Dave Aquino. Again, have a good rest of your evening, and thank you very much for attending. Take care.